For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. We are managing your financial future. Thank you. I always thank myself when I do this because that's my intro. Did you hear the intro? We don't really actually hear the intro.
I don't.
No.
I've never heard the intro.
Well, you've heard it if you've heard the show, but you don't hear it when we.
I've never heard the intro.
You're too critical of yourself.
I don't want to hear me.
You don't want to hear you. Well, a lot of people do want to hear you. And thank you for joining us. This is Managing Your Financial Future. I'm your podcast host, Johnny Dean, not an advisor, but here with the advisor, Professor Rick Plum, CFP professional, certified financial planner. And it's nice to have you as always.
Thank you.
We're in the new year, as we said before. We're a few weeks into the new year.
It's flying by already.
Yeah, is it? The decade's flying by. This is the 20s, and 2020.
My 20s flew by back when I was in my 20s.
Not like this, though.
And this
Not
is going
like
quicker.
This. And I'm hitting the big 6-0 here in a couple of weeks. So,
Welcome to the party, pal.
I know, that's exactly how I feel. A couple of weeks ago, I don't think it was last week, I think it was 2 weeks ago, we did talk about Roth conversions,
Yes.
And we talked about whether you should do a Roth conversion or not. Is now a good time to do it? You prefer, I guess.
Well, it depends on how structured your income is. If you have a very stable income, your Social Security is turned on, your pensions are on, you know what you're taking from your IRAs, and you've got sufficient reserves so that your income is going to be your income. It's not going to change. It's not variable. If you're going to do a conversion, I like doing them early in the year.
Yeah.
So that any potential growth happens in the Roth, hopefully. Hopefully it doesn't go down this year. Instead of happening in the traditional IRA.
Yeah.
If my income is variable, though, where I don't know what I'm going to spend, or if I have a large personal account where I may have large capital gains or not, where the income varies fairly drastically from year to year, and that happens too, then I tend to wait towards the end of the year to see what my income actually was for the year before I do my Roth conversion, to see how much room I still have in the bracket I think I'm in.
Yeah, that makes sense. Again, that's just kind of simple planning techniques, looking to see where you are now versus where you may be.
But a lot of retirees are fairly stable. Their income is, they know what they're taking from their IRAs. They know what their Social Security is, 3.2% higher than last year.
Yeah, that's not bad.
Yeah, it happens. And they know what their pensions are.
Yeah, I would prefer as a retiree, I'm not there yet, but as a retiree, I would prefer to have a stable income as opposed to one that's variable.
I'd like to have a stable floor with
a
lot of variable to the
guess
upside.
Then that's fine too. All right, there you go. You're one step ahead of me. Now, one of the things that came up in that discussion a couple of weeks ago had to do with Social Security taxation. Now, we did mention it.
Wonderful world.
We did mention it.
Taxes.
Yeah, but we didn't really get into it. And we've had a couple of people ask us again, and we do this maybe once a year, maybe not even quite that often, but we talk about potential ways to potentially manage or lower overall the amount of taxes that you have to pay on your Social Security. And this always takes people by surprise, Professor Plum, or some people anyway.
And we talk about Roth conversions. That's not going to lower the tax on your Social Security. That's going to potentially increase the tax on your Social Security. So we have to understand where we are and how that actually works. And it's different for everybody because it's not just a one size fits all. It's a sliding scale. It depends on what other income you have. So you look at how much Social Security, and it's not what gets deposited into your bank account that they look at. It's the total amount that they pay you before deductions for Medicare, before deductions for obviously tax withholding if you're doing tax withholding on your Social Security, which you can do. So that's one way to start paying your taxes. But you look at the gross payment, and then you basically put it into a formula, and it's all driven by how much other income you have. Other income means everything. Capital gains and losses. You can only obviously use the $3,000 of losses against ordinary income. You get your interest, dividends, tax-free municipal bond interest.
That's got to be loaded onto the cart.
If you have any wages that you may still have, pensions, everything that shows up in that taxable column plus the municipal tax, tax-free municipal bond interest gets added into the equation.
Now, not all of your Social Security gets added in.
In the formula, only half, 50%
of your gross
of the
amount.
Gross Social Security paid to you for the year. So if I'm getting, $2,000 a month before the deductions, $24,000 a year, they're looking at not the 24, they're going half of that, and they're saying we take half of the 24 in this example, $12,000 plus all the other incomes that get included, all that provisional craziness, all the capital gains, all the dividends, all the IRA distributions, everything else, the net rental, real estate, passive income, all those things get added up. And to the extent that all that other income plus half of your Social Security exceeds a certain threshold, then some of your Social Security becomes taxable. How much? How far over the threshold are you?
Yeah.
The further over the threshold you are, the more of your Social Security benefit is going to be taxable, up to a maximum of 85% of your Social Security benefit.
85% of your gross benefit.
Yeah, 85%. That's not an 85% tax bracket. That's saying if I'm getting, $10,000 in Social Security, the most that could be taxable is $8,500 of it. And what bracket? Well, if I'm in the 12% bracket, I pay 12% on that $8,500 or whatever the taxable amount is. So it just goes into the taxable column.
Now,
so you have to figure that out before you figure out your adjusted gross income, which is before you find out what your taxable income is.
Now, we've said many times that there are some Social Security recipients who start taking 62, 63, 64, whenever they retire, and they're happily taking their Social Security payments. And then at age, 73.
Now 73.
Age 73, they have to start taking required minimum distributions. Now, you've said in the past that those required minimum distributions can add income.
Well, that's part of your income. And that's part of that other income category I was talking about. And so it affects, in many cases, how much of your Social Security becomes taxable.
Well, and that's logical for, I think, people to at least understand, because they say, well, wait a minute, okay, I get it. I'm now taking a higher income because I got to take these required minimum distributions. So, yes, my taxable income went up. I could sort of see maybe that would affect my Social Security. Okay. But, there are people also who in their, at age 70, somewhere, they decide they're going to downsize their home. And maybe they've been in a home for 40 years, and
they've got more than $500,000 a gain,
and they've got it's not unreasonable. It's not unreasonable to say maybe they have $1 million of gain beyond what they paid for.
That capital gain that is not excluded because it's the sale of a primary residence. Anything over the $250 per person is part of your overall income, and that gets people by surprise. And it may not even be that much capital gain. It doesn't have to be a house you're selling for $1 million. Maybe you sold a stock for $40,000 or $50,000, and you had $20,000 worth of gain.
Yeah.
But that $20,000 of gain, when added to all of your other income, your total income for the year is still only $100,000. And as a married couple, well, that means that my capital gain is in the 0% capital gain tax bracket after deductions. And you're saying, oh, cool, I don't have to pay any tax. And then all of a sudden you do your taxes and your taxes went up by several $1,000s. Well, wait a minute. Why am I paying tax on a capital gain when it's a 0% capital gain bracket? And it's not the capital gain that you're paying tax on.
It's the
inclusion of Social Security that you weren't paying tax on before that is now taxable. And you're saying, dang. Okay. So, but
even that, and that's true. I brought up the home sale because somebody asked me one time, well, but what if I take the proceeds from the house and I put it in another house? I mean, I have $1 million of gain in this house, but let's say I buy a $900,000 house somewhere else. I'm not keeping that million. I put it into another house.
Well, if you can get in the go back in time machine, you go back to before 1998 and you do it, then you can roll it over and it doesn't show, regardless of the amount of gain. But those rules changed in 1998.
And changed for the better,
for the most part.
I would suggest. But yeah.
But now it's just a matter of we can exclude on the sale of a primary residence $250,000 of gain per owner, and we don't have to do anything with it. It doesn't matter what we do with it. Whether we buy a new house, don't buy a new house. Whether we blow it in Vegas, it doesn't matter. The first X amount of dollars, 250 of gain per person, is excluded. Any gain over that is taxable. Then it doesn't matter what you do with it.
But it's
taxable,
also,
but that's part of the tax return.
Yeah. So it doesn't matter whether you take, let's say you had $1.5 million of gain. You're a married person.
The excluded gain doesn't hurt you.
No.
But the includable gain
can hurt you
it's
from
part of it. It can hurt you in
from a Social
ways.
Security payment,
it can
taxation.
hurt you from Social Security. It can hurt you from income-related monthly adjustment amount, IRMA. It can hurt you from the net investment income tax level.
So it's a pretty big footprint that it can leave on your taxable.
The bigger the gain, the bigger the tax.
So you have to plan for that. Now, are there ways, Professor Plum?
Don't sell the house. Do an installment sale over a couple of years.
Sometimes there's nothing you can do. But part of your, when you put together a bucket strategy, part of your strategy for people is to look at things like potential Social Security taxation. Is there anything you can do?
Well, in just tax management, and we've got a married couple. He's got IRAs, she's got IRAs, and they have personal money, and they need X amount of dollars from their portfolio to be able to supplement their Social Security and pensions, whatever they have. Where do we take it from? His IRAs, her IRAs, the personal account, and it depends. So how much can we take out of the IRAs without affecting the Social Security, and will that be enough to not allow the IRA to grow to a point where the RMDs get out of control? Because we want to look at where the RMDs are going to be in the future if we're not already at that age.
Required minimum distributions.
Required minimum distributions. Currently at age 73.
That's right. Maybe they'll push it even higher someday.
Yeah, that's not a good thing, actually.
It's not in some cases. You're right.
It's not ever.
What, having to do later required minimum distributions?
Yeah.
Well, but you don't. I mean, you're only required. You can take it out sooner.
Right.
You can pretend like it's still age 70 and a half.
You can always take it out. And most people are not affected by the 73, 75 change of the future. It's from 70 and a half to 72 to 73. Because they're taking money out of their IRA to live anyway, which is satisfying their RMD.
They don't even know there's a required minimum distribution, but they've always taken out more.
This is only for the rich people that don't need the money and don't want to pay the taxes. So anyway, that's a whole other discussion.
That's a whole other discussion that we've had before.
But we look at how much income can we take from other sources that doesn't dramatically affect the taxability of the Social Security. What's your goal? How much do you need? Now, if you need 10, 15, 20,000 a month,
a month.
We're there are that's out there. I mean, there are people. I mean, your Social Security is going to be taxable. I mean, get over it. You're going to pay tax on 85% of it. Now let's see where we can keep you in the 12% bracket, or maybe the 22 for now. Let's look at the other end of it. Let's keep you out of IRMA. Let's keep you out of the other things. But if you're in the $50,000, $60,000, $80,000 range, how much can we take out of the IRAs? What are the ages of the individuals? I was speaking with somebody yesterday. Husband's 74, wife is 62. And so we were talking about where do we do conversions. So let's do from his first, because that's the one that's hurting us right now. Let's use up the bracket and get his, because his is the fire that's burning our backside now. Hers is going to burn us, and by the time she's her required minimum distribution isn't until 75, because she was born in 62. She's going to be 62 this year. So it's just how do we make it work? But we're looking at how much can we take without dramatically affecting. So we blend it. How much do we take out of his to be able to satisfy the RMDs? How much do we take out of hers? How much do we take out of personal money? So, which can be including principal, which we can then keep the distribution high but the taxability low. Or have we started taking our Social Security? Should we be doing, maybe we need $80,000 a year and we haven't started our Social Security yet. We can take that all from the IRA and then do another $20,000 or $40,000, $50,000 of conversions on top of that and stay in the true 12% tax bracket. Whereas once they start their Social Security and then they start taking their RMDs and things, it may push them into a higher taxation, just because that dollar from the IRA is being taxed at 12%, but so is 85 cents of the Social Security. So now it's a 21% tax bracket.
I'm telling you, people listening right now, their heads are spinning.
It's because we're talking about taxes.
But I mean, it's when you strategize, and here's the thing. I mean, unless you really know what you're doing, unless you really know what impacted a withdrawal from an account will do, I mean, you can honestly wind up paying taxes and not even know that you could have paid less potentially.
It happens. It definitely happens.
I mean, how's the average person supposed to know this stuff?
Well, the average person doesn't understand the tax return at all.
Yeah, because they have expertise in other areas.
Well, and they made their money in other areas. And when it comes to the tax return, they may sign it. That's when they see it. But they don't look at the numbers on it. They take all the 1099s, the W-2s, all the different forms you get, and they hand it to a tax preparer and say, do this. And unfortunately, that will also mess things up, because if you've done a rollover, if you've done a qualified charitable distribution, if you've done certain things and you don't tell your tax preparer what you've done, they don't know it, and you end up paying tax on something that you thought was a deductible event.
Well, and it's important to note, too, a tax preparer, generally, let's say a CPA, is not the person that you want.
Most tax preparers are not CPAs.
Well, they're not the planner, that's for sure.
No.
I mean, they're tax preparers. They will take the information that you give them and put it onto the form and make sure you pay what you supposedly owe.
Right. And now, if you've had the same tax preparer for years, hopefully if they see an anomaly where, every year you've been taking out 20 grand from your IRA, and this year it shows 40 grand. Hopefully they'll say, was there something special about this? Did you do something different, or was this just an emergency? Now, it's not judgmental. It's just trying to get to the facts. And you say, oh, yeah, I did a qualified charitable distribution. Nothing on the paperwork that you gave them says that. Then you have to remember to tell them that.
Well, I think maybe you could disagree with me, but I think maybe where people get the most hung up on paying taxes on their Social Security payments when they never had them before is when, as you said, when they hit that required minimum distribution age. Would you agree with that?
Two basic events: required minimum distributions, and now they're taking out more than they were before, and they're saying, "Wow, my taxes went up a lot."
Yeah, because they thought they were in the 12% bracket or whatever
and
it
it's
is.
Actually 21. The effective hit on that money.
Why am I paying so much?
Because I'm not paying 12% on a dollar. I'm paying 12% on $1.85. 85 cents was my Social Security that I was receiving anyway.
Yeah.
And then the dollar I took out of the IRA. And the other thing is unexpected windfalls of capital gains. The sale of a house over and above the $500,000, $250,000 exclusion. A capital gain from a stock windfall. Maybe Grandpa gave me a stock years ago, and I finally got around to selling it because I wanted to buy the motorhome to travel after I retired.
What about an inheritance? I mean, some people get an inheritance that late.
Depending upon what you inherited. If you inherit an IRA and you have to start taking money out of the IRA, that's part of the required minimum distributions from a beneficiary IRA. Mm-hmm. That's additional income.
Sure.
But if I inherit a stock, if great-grandfather dies and then gives me a stock that he owned personally, for the last 50 years.
Hey.
I know somebody who put $30,000 into Starbucks not long after they went public. They have never sold any.
I know somebody personally who put $30,000 into Starbucks just last year alone because that's how much coffee costs.
Yeah. They didn't buy the stock. They were just
No, they were just buying coffee. I'm kidding.
No, this person, they put, I think, $30,000 in, 20, 30 years ago, whatever it was.
Right.
Now they get $120,000 a year in dividends.
Wow.
but they're saying, I can't sell this stock because the capital gain is, multiple millions of dollars.
Well, it's a good problem to have. But
when they pass away, their kids are going to inherit it. Kids can sell it next day and not have to pay any taxes. So that type of inheritance doesn't necessarily affect your taxable income. Inheriting an IRA, inheriting an annuity, inheriting some kind of tax deferred account, that is taxable income that you're going to have to take out at some point. And a beneficiary of an IRA who is not a spouse, who is more than 10 years younger than the owner, and who is not disabled, has a 10-year time horizon to get the money out. Some of them have to start taking money out the year after the year of death.
Yeah.
Some of them don't have to take money out until the 10th year. Regardless of whether you're in either one of those two categories, you may want to start taking money out of a beneficiary IRA before the 10th year just to avoid the huge taxable hit of deferring another 10 years. Now, that's a different game between a traditional IRA and a Roth IRA. A Roth IRA, assuming I can afford to, if I were to inherit one, I would leave it till the last minute of the 10th year. There is no distribution required from the Roth IRA, beneficiary Roth IRA, for the first 9 years after death. But 100% has to come out in the 10th year. And that's tax-free, so might as well let that thing run.
So when you're talking about trying to manage your taxes from a Social Security taxation standpoint,
You're looking at all this stuff.
I mean, to me, it's unless you really know what you're doing, it's almost impossible to.
Yeah, I mean, well, that's anything. I mean, try rebuilding a motor on a car. Unless you know what you're doing, you're going to screw it up. Try brain surgery. Unless you know what you're doing.
Well, that is true, but most people aren't going to be in a situation where they have to perform brain surgery. You actually have to actively do that. But people do inherit things. People do have Social Security payments. Yeah. They're just receiving this stuff. They have 401k withdrawals that they're doing.
Right.
And if you go online and you say, well, gee, okay, I've got a 401k, I've got a Roth IRA, I've got some personal money, I've got this and that. I need a certain amount of money every single year to live off of. Where am I going to take this money? Now, first of all, somebody's got to be savvy enough to actually ask those questions.
And to know they have 3 basic different types of accounts.
Yes. Now, fortunately, people listening to this podcast, I think, have some of that savvy because that's why they're listening to this podcast. But they may not understand necessarily the consequences of doing things when you go online and somebody says, don't ever pay taxes before you have to.
Well, for years, we've talked about the fact that if you go online and you ask, where should I withdraw my money from first? Personal money, Roth money, or IRA money? Invariably, it was don't spend IRA money until you're required to take it out by the RMD age. Use your personal money. Never spend your Roth money. Leave that for the kids. And that has started to change. I'm seeing more and more articles that say never touching your IRA until 73 and older is not necessarily the best advice.
Yeah.
Blending it, taking some money out earlier, trying to manage, like we talked about before. How much can I take out without dramatically affecting my Social Security? Or a couple of days ago, I was talking with somebody, their pensions and Social Security, and they were already towards the top of the taxability of the Social Security. If they took out another $3,500, they'd maxed out their taxability of their Social Security. And so now we're pretty much done talking about Social Security. Now we're talking about true taxes. Once the Social Security, once 85% of the Social Security is taxable, now we go back into the true brackets, and they still had quite a bit of room, or some room, in the 12% bracket that we could do conversions with a true cost of 12%. We just had to get over that little bump of $3,500 that was costing, 21%. But then it's weird. Your bracket went up, then it came down, and so, but again, understanding it and being able to run the formulas and be able to run the calculations. It's all a matter of knowing where you're at and doing what you can to help manage it. And also, it's not just today. You're looking at the future too. Maybe you've got one spouse taking their Social Security and the other spouse is waiting until age 70. Typically, when we see that, it's the lower wage earning spouse that starts early. And so it's pretty easy to hit the 85% mark on the taxability of that Social Security. And so we're already past it. Let's do what we can before the big Social Security starts a couple of years from now when the higher wage earner hits age 70.
Right.
Let's take advantage of what is available to us. Yes, that may mean paying more taxes today than we could otherwise get away with, but it means paying less taxes in the future than you're going to be stuck with.
And that's what gets to people many times, I think, because they think, well, why pay taxes today? Why don't I just put it off? If I eventually owe it, that's fine, but why don't I just eventually put it off?
Because if I can pay it today at 12%, and avoid paying it at 24% later on or some higher number later on.
Yeah.
That's a good thing. And I'm not saying take it out and spend it. I'm saying, if you want to spend it, fine, but take it out and convert it to a Roth. That way you'll never have to pay tax on it again. And not only will you not have to pay tax, if you're a married couple and you pass away, your surviving spouse, who has a much more limited tax planning issue because the taxes are much higher on a single individual with the same income than a married couple, then it helps the survivor lower one of their expenses, the expense being taxes. And
and we talked about a couple of weeks ago the benefits of having money in a Roth. I mean, the benefits of having it already in a Roth are spectacular.
Right, but it's a cost of getting it there.
There's a cost of getting it. Now, whether you pay that cost, if somebody else is going to pay that cost because they died, and they paid to get it in, that's fine. But there is a cost to doing that.
And sometimes that cost is fairly dramatic. I was speaking with somebody yesterday, very blessed in their financial ways. Their income is multiple seven figures.
That's like millions, isn't it?
Yes.
Yearly, couple
Annual
million.
income is a couple million a year.
Wow.
Net worth, over 10. And they've got $1.8 million or so of IRA. Most of it's not IRA. And they're looking towards RMDs. They're looking at what their kids
How old
are
are
doing.
they?
One is 73. One is 65.
Okay,
60.
so all right.
And we're talking about taxes, and they're saying, should we consider conversions? And I said, well, you're in the 37%. Luckily, they're in a state that does not tax them. So it's just the federal tax. I said, well, you're in the 37% income tax bracket. Do you see any time at any point in your future
where you're going to be in a
lower bracket? Yeah. And they were responsible was, well, do you think tax brackets are going to go down? Well, not on them. I don't. I don't know what's going to happen in the future, but I sure don't think the tax bracket's going down on them.
On the 37%.
On somebody making $2 million a year.
Yeah, it's unlikely.
And there's a high likelihood, in my opinion, that bracket could go up in 2 years.
Well, isn't it by default supposed to go up?
By default, if Congress does nothing, which
It'll
is what
up.
they're really good at, it will go up for the 2026 tax year. It'll go up from 37 to 39.6.
It'll go back to what it was in 2017
17
or 17.
17
yeah.
was the last year.
Yeah.
So it'll go back. The 12% will go to 15. The 22% will go to 25. The 24 will go to 28.
Yeah.
They'll all go up a little bit. We'll get rid of the SALT limitation.
Hey,
got that going for us.
That's the
state
and local tax.
Yeah. For those of us that live in states that have high income tax.
Yeah.
We don't like that thing.
And I think the personal exemptions would come back.
The personal the standard deduction would go back to the lower number, but we would get the personal exemptions.
Great.
Yeah. So we'll see. But the tax brackets go up.
Yeah.
And so that happens automatically unless Congress can get together and do something. A, that means they're willing to do something. B, it means they can work together and do something, which who knows if they can do that. Otherwise, in 2026, it happens.
You said these people that you were talking about, if they don't think taxes will ever go down for them, you're saying
they're going to consider, and their kids are in high brackets too already.
Yeah. Okay, so they could go ahead and convert.
So they're considering converting all of it in the next 2 to 3 years.
Yeah.
That's a big, and the amount it's just a matter of the appetite of writing a check to Uncle Sam.
They're going to lose it anyway, apparently.
Yeah, they're going to lose it one way. They understand that it's going to go, 37+% of it's going to go away. So would they rather have 37% of it go away today and then let the rest of it grow tax-free forevermore as long as they're alive? Or wait and let 37% of it grow, including the future growth, get taken away?
Yeah. So maybe in that case, the sooner the better.
Right. So they're looking to accelerate that tax because they think they don't see any time that their taxes are going to be lower. What a shame. I love it.
We're almost out of time, but just to wrap this up, I was kind of keeping it somewhat on the Social Security taxation, but the problem is...
Their Social Security is taxable, by the way.
Well, yeah. The problem is when you talk about Social Security taxation, you have to get into the other aspects of taxation.
You do.
Because that's what determines whether or not your Social Security is being taxed.
It's all about the other income. You've mentioned it in prior years. If the only income you have is Social Security, even if you have two high wage earners, they don't have any income from any other source, no pensions, and they're both getting $40,000+ a year from Social Security. Mm-hmm. They got $85,000 a year from Social Security. They're not paying any taxes.
That's just the way it's structured.
That's the way it is.
Yeah.
But if you start throwing in $10,000, $15,000
at that point
of other, and usually somebody in that situation, two very high wage earners, they have other money.
Yeah,
whether it be IRA or other things.
No, it's very rare where you only see that.
But if the only income you have is Social Security, you're not paying taxes. It's this inclusion of other income that affects the Social Security, the taxability of your Social Security. So how do we manage the taxability of your Social Security? We look at all these other incomes. What can we do different in these other incomes?
And as you said, it has to do with where you take the withdrawals from.
Yeah.
And by blending potentially, personal money, IRA money, right. You can affect you may be able to lower that tax that ultimately you may have to pay in your Social Security.
We had a a couple. He's been doing distributions from his IRAs, and she has not been taking any distribution from her IRAs. Well, she's getting to 73, 74 years of age now, and so now she has to start taking required minimum distributions. So what we're doing, though, is we've reduced what he's taking and increased what she's taking to try to blend out so that we don't just continue taking what he was taking and then throw hers on top of it, which, makes more income just to satisfy her RMD. We take enough to satisfy his, and we take enough to satisfy hers, and the combination of the two of them is enough to satisfy what they need to live on.
You need help doing this, folks, and that's kind of why I wanted to talk about it. It's an offshoot of that topic from a couple weeks ago, but we did have people ask us about it. And so as confusing as it is, there is help for you. You can talk to Professor Rick Plum or any of the Lucia Capital Group advisors, 800-644-1150, 800-644-1150. I would suggest you do this because, as I said a few minutes ago, people's heads are spinning. And it's because every action that you take when you take money out of an account, whether it's personal, IRA, or Roth, potentially has a reaction down the line. And usually it has to do with a tax bill, either higher or lower.
That bill that we all love.
Yes. So don't make a move before you talk to one of the Lucia Capital Group advisors at that number, 800-644-1150. Also go online, find a lot of this information, more in-depth in some cases, at luciacap.com, LUCIACAP.com. And, of course, subscribe to this podcast. We got more new subscribers. You talked to a couple of people just, yesterday?
No, it was on my little vacation.
Okay.
I found out my brother-in-law in upstate New York watches the videos that we do religiously. Right. Can't wait to have them drop. He loves listening, watching those.
Sure, yeah.
And I said, well, aren't you listening to the podcast too? And he goes,
What podcast? Oh, come on.
So...
We've only been doing this for years.
This is all about you, buddy.
All right, there you go. All right, it's directly from Rick. Always happy to have new subscribers. You can go to Apple Podcasts, Spotify, and easily download this every episode to your device, whatever you happen to listen on. Professor Plum, thank you so much.
You're very welcome.
As always, I hope we didn't leave people with more questions than answers, but if they did, give us a call, let us know, and we'll try to help you out. Send us an email as well at luciacap.com. For Professor Rick Plum, CFP Professional, I'm your podcast host, Johnny Dean. Thanks so much for listening. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Municipal bond interest may be subject to the alternative minimum tax. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.